What if I told you that right now, at this very moment, an artificial intelligence is making investment decisions faster than any Wall Street trader ever could, without fear, without greed, and without sleep? Here's the real question. If a machine can analyze millions of data points in seconds, does that mean human investors are becoming obsolete now? Let's go a level deeper, because one of the biggest misconceptions people have is thinking AI investing is only for billion-dollar hedge funds or Silicon Valley insiders. That's no longer true. AI is quietly entering everyday investing through brokerage platforms, retirement plans, ETFs, and even simple portfolio tools. When you rebalance a 4-to-1 automatically, when an app adjusts your asset allocation, when a platform suggests diversification based on volatility, that's not a human advisor sitting there making those calls. That's an algorithm applying logic at scale. And whether investors realize it or not, they're already participating in AI-assisted markets. Another critical issue to understand is how AI changes market behavior itself. When millions of algorithms react to similar signals, interest rate changes, inflation data, earnings surprises, the market can move sharply in seconds. This is one reason we now see sudden spikes, flash crashes, and rapid reversals. Humans often interpret these moves emotionally, assuming something must be wrong. AI doesn't assume, it reacts. Then it recalibrates. That difference in reaction speed is why many retail investors feel like the market moves before they even understand what happened, but speed alone doesn't equal intelligence. AI systems are only as good as the data they're trained on. When markets behave in ways that don't resemble historical patterns, AI can struggle. This becomes especially important during regime changes, periods when inflation behaves differently, when interest rates move faster than expected, or when political decisions reshape entire industries overnight. In those moments, humans who understand context, incentives, and long-term consequences can still spot opportunities that machines misprice. There's also a growing concern about herd behavior among AI systems. When many algorithms rely on similar models, similar data, and similar assumptions, they can amplify trends rather than correct them. This can lead to overcrowded trades, exaggerated momentum, and sudden collapses when the model assumptions break down. Human investors who recognize these conditions can step back, reduce exposure, or even take the opposite side of the trade, not because a model told them to, but because experience and judgment signal caution. Another overlooked advantage humans have is adaptability. AI must be retrained. Humans learn in real time. When a new technology emerges, when consumer behavior shifts, when a business model quietly changes direction, human investors can adjust their thinking without waiting for data confirmation. This is especially relevant in early-stage innovation, where numbers lag reality. AI sees confirmed trends. Humans can sense emerging ones. At the same time, ignoring AI entirely is a strategic mistake. The smartest investors are not asking whether to use AI, but how much to rely on it. They use it to eliminate obvious mistakes, reduce bias, and improve efficiency. They let algorithms handle repetitive tasks, risk calculations, and portfolio balancing. This frees mental energy for higher-level thinking, evaluating leadership quality, competitive advantages, and structural shifts in the economy. Consider risk management. One of the most common reasons investors fail is not because they pick bad assets, but because they manage risk poorly. AI excels here. It can instantly model worst-case scenarios, stress test portfolios, and identify hidden correlations. Humans often underestimate risk during good times and overestimate it during bad times. AI stays neutral. That neutrality can be extremely powerful when markets become emotional. Another area where AI changes the game is personalization. Traditional investing advice was one size fits all. AI allows strategies to be tailored to individual goals, timelines, and risk tolerance. Two investors with the same income can receive completely different portfolio recommendations based on behavior, preferences, and financial history. This customization was once only available to the ultra-wealthy. Now it's becoming mainstream. However, personalization also introduces responsibility. When investors blindly follow AI recommendations without understanding them, they surrender control. This can be dangerous. Technology should inform decisions, not replace accountability. Every investor still needs to understand why they own what they own. AI can guide, but it shouldn't become a black box that removes awareness. There's also an educational gap forming. Investors who learn how AI works, even at a basic level, gain a significant edge. They know what AI is good at, where it fails, and how to interpret its outputs. Investors who don't understand it may misread signals, panic at the wrong time, or place too much trust in automated systems. Knowledge, once again, becomes the true differentiator. As AI continues to evolve, the definition of a skilled investor is changing. It's no longer about memorizing ratios or predicting short-term price movements. It's about synthesis, combining data, technology, psychology, and patience into a coherent strategy. Humans who can think independently, question assumptions, and remain disciplined will not disappear from the markets. They will become rarer and more valuable. And this transition won't happen overnight. There will be periods where AI underperforms, moments when human intuition shines, and cycles where the balance shifts back and forth. Markets are dynamic systems. They reward flexibility. Investors who cling to old methods or blindly worship new ones both risk falling behind. The advantage lies with those who stay curious, adaptable, and aware of how the game is changing in real time. One of the most important mindset shifts investors must make is understanding that AI doesn't remove uncertainty from markets, it redistributes it. Volatility doesn't disappear when machines dominate trading, it often increases. When confidence in models is high, capital piles into similar strategies. When confidence breaks, exits become crowded. This creates sharper moves, faster corrections, and shorter reaction windows. Human investors who recognize this environment can design portfolios that are resilient rather than reactive, emphasizing diversification, liquidity, and time rather than constant action. Another subtle change AI brings is how narratives spread. Markets have always been driven by stories, but now those stories are quantified. Sentiment analysis tools scan headlines, earnings calls, and social media to measure optimism or fear. This means narratives move prices faster than ever before. Humans used to hear the story first and then act. Now prices often move before the story reaches the average investor. Understanding this dynamic helps explain why markets sometimes feel disconnected from common sense. It's not irrational, it's accelerated. This acceleration also challenges traditional advice. Concepts like buy the dip or wait for confirmation work better in slower markets. In AI-driven environments, dips can be shallow or violent, and confirmation often comes late. This doesn't mean long-term investing is broken. It means execution must be more thoughtful. Investors who rely on rigid rules without context may find themselves consistently late. Flexibility, patience, and position sizing become more important than perfect timing. There's also the question of trust. Many investors are uncomfortable trusting machines with money, and that skepticism is healthy. Blind trust is dangerous, whether in humans or algorithms. The key difference is transparency. Humans can explain their reasoning, even if it's flawed. AI often can't. This black box problem means investors must judge AI systems by outcomes and consistency rather than explanations. That's a shift, and it requires discipline and monitoring rather than blind faith. Another factor worth considering is regulation. As AI becomes more influential, regulators are paying attention. Rules around algorithmic trading, data usage, and market stability will continue to evolve. These changes can alter incentives and strategies overnight. Humans who follow regulatory trends and understand policy implications may spot risks and opportunities before algorithms adjust. Regulation is not just a constraint, it's a signal. The human advantage also shows up in values-based investing. Environmental, social, and governance considerations often involve qualitative judgment. While AI can score metrics, it struggles with intent, authenticity, and long-term reputation risk. Human investors can decide what aligns with their principles and goals. As more capital flows into values-driven strategies, this human layer becomes increasingly relevant. Another underestimated skill is patience. AI operates continuously. Humans can choose not to act. In many cases, doing nothing is the best decision. Overtrading remains one of the biggest performance killers for individual investors. AI can trade constantly without fatigue, but humans who try to match that pace often make mistakes. Choosing an activity when conditions are unclear is a strategic advantage, not a weakness. Learning how AI behaves also helps investors manage expectations. AI doesn't aim to be right every time. It aims to be statistically correct over many iterations. Humans, however, often judge success trade by trade. This mismatch can cause frustration and abandonment of good strategies during normal drawdowns. Understanding probability variance and long-term outcomes helps investors stay committed when results temporarily disappoint. Another shift is the democratization of tools. What once required massive infrastructure is now accessible through consumer platforms. Charting, screening, backtesting, and optimization tools are widely available. This levels the playing field, but only for those willing to learn. Access alone doesn't guarantee success. Skill still matters. Discipline still matters. Psychology still matters. Education, therefore, becomes the most valuable investment. Not just learning how to pick stocks, but learning how markets function, how AI influences price discovery, and how incentives shape behavior. Investors who continuously educate themselves are less likely to be surprised. And surprise is often what leads to panic. It's also important to recognize that AI reflects the goals it's given. If the objective is short-term profit, AI will pursue it aggressively. If the objective is stability, income, or risk control, AI behaves differently. Humans choose the objective. That decision shapes outcomes more than the sophistication of the model. Clarity of goals is something no algorithm can provide for you. As AI systems grow more powerful, competition increases. Edges become smaller and more fleeting. This makes humility essential. No strategy works forever. No system is invincible. Markets evolve as participants adapt. The willingness to reassess assumptions and adjust strategies is what separates long-term survivors from short-term winners. Another reality is that AI doesn't eliminate cycles. Booms and busts still occur. What changes is the speed at which they unfold. Human investors who prepare emotionally and financially for cycles are less likely to make catastrophic mistakes. This preparation includes maintaining emergency funds, avoiding excessive leverage, and resisting the urge to chase performance. In the end, the presence of AI forces investors to confront uncomfortable truths. Many losses aren't caused by lack of intelligence, but by lack of discipline. Many missed opportunities aren't due to poor information, but poor execution. AI exposes these weaknesses by operating without them. Humans who acknowledge and correct their behavioral flaws can coexist and even thrive alongside machines. This evolving relationship between AI and human investors is not a battle with a final winner. It's an ongoing negotiation between logic and judgment, speed and wisdom, data and meaning. Those who understand both sides gain perspective. Those who ignore either side limit themselves. The market doesn't reward ideology, it rewards adaptability, awareness, and consistency over time. As this transformation continues, one of the most underestimated challenges for investors is maintaining clarity in an environment of constant signals. AI-driven markets produce alerts, indicators, forecasts, and recommendations nonstop. For many people, this creates noise rather than insight. The human brain isn't designed to process endless streams of information, and excessive inputs often lead to decision paralysis or impulsive actions. Learning when to ignore data is just as important as knowing when to act on it. This is where investment philosophy becomes critical. AI can optimize within a framework, but it cannot define that framework for you. Whether you believe in value investing, growth investing, income strategies, or macro-driven approaches, having a clear philosophy acts as an anchor. It filters information and prevents constant strategy hopping, which is one of the most common reasons investors underperform. Without a guiding philosophy, AI tools can push investors in too many directions at once. Another area where humans still dominate is understanding incentives. Markets are shaped by incentives, corporal incentives, political incentives, regulatory incentives, and human behavior under pressure. AI can observe outcomes, but it doesn't inherently understand motivation. Humans can ask deeper questions: why is management behaving this way? Why is a government prioritizing certain policies? Why are consumers shifting preferences? These questions often reveal opportunities before they show up in the data. There's also a social dimension to markets that AI struggles to fully capture. Trust, reputation, leadership, credibility, and brand loyalty are difficult to quantify but deeply influential. A company's ability to attract talent, inspire customers, or navigate crises often determines long-term success more than short-term financial metrics. Human investors can assess these qualities through observation, experience, and contextual understanding. As AI adoption spreads, competition among algorithms intensifies. When many systems identify the same inefficiency, that inefficiency disappears quickly. This means easy opportunities become rare. Returns become harder earned. In this environment, edge comes from process rather than prediction. Investors who focus on repeatable processes, saving consistently, rebalancing intelligently, managing risk, are more likely to succeed than those chasing the next big insight. Another key consideration is how AI affects market confidence. When markets rise rapidly due to algorithmic momentum, investors may assume fundamentals no longer matter. When markets fall quickly, they may assume something is fundamentally broken. Both assumptions can be wrong. AI accelerates movement, but it doesn't rewrite economic reality. Understanding the difference between price movement and value remains essential. Long-term investors also need to think about time horizons. AI operates on microseconds to days. Humans can operate on decades. That time advantage is powerful if used correctly. Compounding rewards patience. Businesses take time to grow. Economic transformations unfold over years, not seconds. Investors who align their strategies with long-term trends, demographics, technology adoption, productivity, can let AI-driven volatility work in their favor rather than against them. There's also an emotional benefit to this perspective. Constant engagement with short-term market movements increases stress and reduces decision quality. AI doesn't feel stress, but humans do. Designing an investment approach that minimizes emotional strain improves both performance and quality of life. This includes setting rules in advance, automating contributions, and limiting how often you check your portfolio. Another important shift is collaboration rather than confrontation. Instead of viewing AI as a competitor, investors can view it as a training partner. By studying how AI reacts to data, humans can learn about market sensitivities and risk factors. This feedback loop can sharpen judgment rather than replace it. The goal isn't to outthink machines, it's to think alongside them. As AI continues to learn from markets, it will also learn from human behavior. That means predictable human reactions become exploitable. Panic selling, euphoric buying, and overconfidence are patterns that algorithms can anticipate. The more disciplined and self-aware an investor becomes, the less exploitable they are. Emotional mastery becomes a competitive advantage. It's also worth acknowledging generational differences. Younger investors often embrace technology more readily, while older investors may rely more on experience. Both perspectives have value. Technology without wisdom can lead to reckless risk-taking. Wisdom without adaptation can lead to missed opportunities. The most resilient investors integrate both, leveraging tools while respecting lessons learned through cycles. Another subtle but powerful factor is accountability. AI systems don't feel regret, humans do. This can be a weakness, but it can also be a strength. Reflection after mistakes leads to growth. Reviewing decisions, identifying errors, and adjusting behavior is how investors improve. AI optimizes mathematically, humans evolve psychologically. As markets become more complex, simplicity gains value. Overly complex strategies are harder to maintain, harder to understand, and easier to abandon at the wrong time. AI can manage complexity, but human investors must live with it. Simpler strategies are more likely to be followed consistently. Consistency often matters more than sophistication. Capital allocation is ultimately a human responsibility. Deciding how much to invest, when to take risk, and when to protect capital reflects personal circumstances and priorities. AI can assist, but it cannot define what success means for you. That definition, financial independence, stability, legacy, flexibility, comes from human values. As this landscape evolves, the most dangerous position is complacency. Assuming AI will handle everything leads to disengagement. Assuming humans will always dominate leads to denial. The investors who thrive are those who stay engaged, informed, and adaptable without becoming obsessed or reactive. This era challenges investors to raise their standards. It demands better understanding, better discipline, and better alignment between tools and goals. AI is neither a savior nor a villain. It's a mirror, reflecting strengths and weaknesses more clearly than ever before. Those willing to look honestly at that reflection gain the opportunity to improve. Those who look away risk being shaped by forces they don't understand. The real message behind everything we've discussed is simple but powerful. AI is not here to replace human investors. It is here to expose who's prepared and who is not. Markets are no longer slow, forgiving, or dominated by intuition alone. They reward clarity, discipline, and adaptability. AI has raised the standard, and every investor now operates in a smarter, faster, and more competitive environment. The investors who struggle in this new era won't fail because they lack intelligence or access to tools. They'll fail because they refuse to evolve. AI doesn't punish people, it reveals habits. It exposes emotional decision-making, overconfidence, impatience, and the tendency to chase noise instead of value. At the same time, it rewards those who stay calm, think long-term, manage risk, and remain committed to a clear strategy. This is where human strength still matters most. Judgment, patience, values, perspective. These are not weaknesses in an AI-driven world, they are advantages. When paired with the right technology, they become powerful. The future belongs to investors who understand that success is no longer about beating machines, but about mastering themselves while using machines wisely. So the takeaway is this: don't fear AI, don't worship it, and don't ignore it. Learn how it works, respect its strengths, and recognize its limits. Build a strategy that reflects your goals, your timeline, and your tolerance for risk. Let technology support your decisions, not control them. Because in the end, the market doesn't reward the fastest or the smartest alone. It rewards those who are prepared, disciplined, and willing to adapt. And in a world where AI is everywhere, the most valuable edge you can develop is becoming a better, more intentional investor.